Hello and welcome back to Market Glitch. My name is Dion here in beautiful Sarasota, and today I have my friend Brian. Hi, Brian.
Hi, Dion.
And Brian, where are you?
I'm outside of Chicago, Illinois.
So the weather here in Sarasota is beautiful now, about maybe mid to low 70s. How is it there in Chicago?
It made it up into the high 40s today. According to the weather forecaster, she said that the average is about 41 for this time of year, so it was actually a little nice.
Okay, well, yeah, and we'll see if we can get those historical temperature data into a data series that we can analyze in our trading models one of these days.
That'd be very cool.
Have you heard of James Altucher?
I have not.
He's a blogger and an author. He wrote a book called Trade Like a Hedge Fund. And one of the strategies in his book is the strategy we looked at the other day, you and I. It's based on prices going down a consecutive number of days and then going up a consecutive number of days. In his book, he calls it the 3x2 system because you buy when prices go down 3 days in a row and you sell when prices go up 2 days in a row. I think we tested it out with a 4x2 variation. And
Yes.
Brian here is actually one of my beta testers for a new product that I'm developing. Still kind of a secret, but we're going to take an early peek at it here and kind of see what it can do. Brian, you implemented that model by using these building blocks, if I'm not mistaken, right?
Correct.
So you used indicator compared to value, and the indicator for the buy condition was consec down, which measures the number of consecutive times something goes down based on a look-back period. So in our case, we want a look-back period of just one because we want to look at closing price, so consecutive down of closing price greater than or equal to 4. So that will be our entry condition. So we'll buy the next bar at market open if price goes down 4 days in a row. Does that look right?
Yes.
Okay. And then to sell, we will specify the reverse. We'll say consecutive up, look back period of 1 must be greater than or equal to 2 because we want to sell after it goes up 2 days in a row. So right there we have the trading model that you were so excited about yesterday.
Yes.
So let's kind of test that on one symbol. What symbol should I use for our first test of this trading model?
Let's try Microsoft.
Okay, there we go, Microsoft. Okay, so I do see some entries here. I see a couple of histogram graphs on the bottom. That is the indicators, consecutive down and consecutive up. So once consecutive down was down 4 days in a row. So the first day was here. This was the first down day. This was the second. This was the third. Even though it's a green bar, the closing price was less than the previous closing price. And this is the fourth. So this was the entry bar. So it buys the next bar on market open. So it bought it here and it sold it here after 2 consecutive up days. So here's the result on Microsoft. Let's look at our metric report. So it had 99 trades, a profitable positions, 62%. So almost 63% winning trades. It did have a net profit overall. We weren't really matching the position size of the buy and hold strategy. So let me change our position size here real quick. So instead of 5% of equity, let's take all of the available capital for Microsoft, and each trade will get 100% of equity. So we'll run it again. And now, if I look on the bottom, I see even the net profit, 93%, beats the net profit of the benchmark in that period. So for the benchmark, we compare it to SPY in this case. So we can look again at the backtest results, and let's look at the equity curve. So here we can see the black line is what the overall market based on the SPY proxy did. And then the blue line is how our trading model 4x2 performed. But what gets really interesting is if we run it on a group of symbols, let's say the NASDAQ 100, and let's go back and change our position size back to something more reasonable. So we'll say 10% of equity for each position. And then we'll run that on the NASDAQ 100.
This is truly amazing.
So there is the result on the NASDAQ 100.
That is amazing.
Since, I think, let's see where our first trade occurred. Position list, yeah, 2000. So we started back testing in the year 2000. We have a annualized return of 16.87% compared to an annualized return of SPY of 3.41%. So that seems to be a pretty good trading strategy. And when you ran this, I think you commented something to the effect that you'll be retiring soon since you've seen this.
Yeah, it is truly amazing that I mean, obviously with all of the choices that you have for all the conditions, that something that seems so simple could be so profitable. It's really amazing.
Well, yeah, let's thank our friend James Altucher for that. A few years ago, he did mention that he thought that the strategies in his book, Trade Like a Hedge Fund, weren't really working anymore, except this one. He said that 3x2 is still kind of working, and it appears that it is. So, however, we can't judge a trading model based only on profit. We have to look at the other things here too. So one thing that I noticed is this maximum drawdown of 50%. And we even have a drawdown viewer here, which I can change to a percentage view. So you see this spike right down here where it hit 50%.
Yes.
So the drawdown indicates the largest loss that the strategy experienced during its backtest period. So if you were to trade this 4x2 on the NASDAQ 100, you might have to stomach a loss of up to 50%. So that's definitely not easy. It would be hard to kind of stomach that loss, I think.
Yeah, but if you look at the whole chart and see what happened, I think pretty much it's well known that the market goes up and down, right? So the ultimate part of this is, as you see in the chart, it ends up. And
right. Yeah, it depends on your time frame. I mean, if your trading goal is a long-term appreciation of your capital, then you might not worry about, let's see how long, you might not worry about the 800, see this here, bars since equity high, the 800 trading days it would have taken to recover the loss. But a lot of people trading would, maybe not even be able to last 80 days, let alone 800. You know what I mean?
Oh, for sure. And the other thing is, if you sat out during that time, that wouldn't have necessarily put you in a better position. Because you still, if you look at the metric report, you still ultimately end up with that profit, right?
Oh, yeah, definitely.
Right.
But, some system traders, myself included, will be looking for models that have lower drawdown and more, I guess, less volatility in the returns.
So do you normally set a limit of like 20% or 25% or?
Well, yeah, I in a back test, I personally I would like to see it no greater than, maybe 25%. But everybody has their own risk tolerance and their own kind of personal, internal limits that you need to understand and then, find a model that matches your own expectation and your own personality.
Of course.
So I think, this is a pretty incredible, though, that the fact that you could generate such a impressive return with just a couple of simple rules like that is very interesting. I mean, it shows the concept of keep it simple, which is actually pretty true in trading strategy developments. Oftentimes, the more complex rules and formulas you add to a strategy actually makes the performance worse. So, here we have a simple strategy that buys low and sells high and generates a impressive return, albeit with, a decent amount of volatility and drawdowns. Any other thoughts on the strategy, Brian?
No, I really agree with the keep it simple. I mean, it's pretty amazing that with just basically 2 indicators that you're using that you can generate that. And no need to muck it up with anything more complicated.
All right. Well, thanks a lot for joining me this time.
No, thanks for having me.
Yep. And we will try to show more sneak previews of my top secret project in future videos as well.